Bill Ackman shared that he thinks you can do very well as a stock market investor if you find really high quality companies and you buy them at attractive prices. And he thinks today is a pretty good time and a good point of entry. Bill Ackman started sharing by saying, "It is much easier to make money in the stock market in the rising stock market environment. A declining interest rate environment isn't generally a market in which asset prices increase." He thinks that what matters is, are the central banks around the world going to stop this out of control inflation, and he thinks they will. 24 months ago, central banks around the world were worried about deflation, and that's been a very dramatic change. He thinks one can do very well as a stock market investor if one finds really high quality companies and buy them at attractive prices. And he thinks today is a pretty good time and it's a pretty good point of entry. Bill Ackman mentioned that the stock market has been collaborating this year due to high inflation and the higher interest rates that come along with it. Inflation is running at its highest rate in generations, and this is scaring the US Federal Reserve. In an attempt to get inflation under control, the Fed is raising interest rates dramatically, and this is negatively impacting stock prices. The hope is that increasing interest rates will help slow down the economy and cool inflation. In investing, the most commonly used metric to measure interest rates in the economy is the yield on the 10-year US Treasury bond. Yielded is just a fancy way of saying interest rate. This would be the return you could expect to receive for lending the US government money for 10 years. The yield on the 10-year Treasury was just 0.5% in the summer of 2020 and has since risen all the way to 4%. This is a nearly 8 times increase in just 2 years. Now, investing during normal times is hard enough, but add on to rising interest rates and that makes things even more difficult. In the words of Warren Buffett, interest rates are like gravity on stocks. The higher interest rates go, the more downward pressure there is on stock prices. He means the stock is valued based on the cash you'll generate discounted back to the present day using a given interest rate. This so-called intrinsic value is how much the stock is worth. Let's see how rising interest rates impact the intrinsic value of stocks. Let's say we have a stock that will generate $20 in cash for us in 1 year. In this example, the stock will be able to grow the cash you generate by $20 a year for 10 years. So $40 in year 2, $60 in year 3, and all the way to $200 in year 10. We're going to say the company stops operating in year 10, so you won't receive any cash from selling the stock. Now, in order to determine a value for this stock, we have to discount it back using an interest rate. Let us start out with a 5% interest rate. This gives us a stock price of $787. Let's see what happens as interest rates start to climb. If we take the interest rate, we use the 7%. This caused the value of the stock price to fall to $695. Notice how the stock is worth less than before despite producing the same amount of cash. The only thing that changed was interest rate. If we take the interest rate all the way up to 10%, we see that our stock price falls below even further all the way to $581. Just raising the interest rate from 5% up to 10% caused the value of our stock in this example, the fall by 26%. But given that interest rates are rising, why does Bill Ackman think now is a great buying opportunity? It has to do with the fact that he believes that the Federal Reserve will be able to get inflation under control. Once inflation is brought back under control, the Fed can stop aggressively raising interest rates. In fact, the Fed might actually start lowering interest rates once inflation starts to normalize and the economy weakens. So if we go back to our earlier example, let's see what happens as interest rates decrease. We saw that a 10 interest rate resulted in a stock price of $581. Remember, rising interest rates are like gravity on stock prices, pulling stock prices down as interest rates increase. But on the other hand, decreasing interest rates are like jet fuel propelling stock prices higher. Let's bring the interest rate down to 8%. This causes our stock price to rise to $654. Let's take the rate down even further to 6%. This causes another bump to our stock price, setting this price up to $739. If we get really extreme and take the end rate all the way down to 2%, the stock price skyrockets all the way to $959. At the start of the conversation, Bill Ackman was making the argument that people who buy stocks now are going to benefit from the tailwind of interest rates coming down as inflation starts to get under control. As we saw in our example, declining interest rates are positive for all stocks. However, Ackman was quick to point out that investors shouldn't just buy any stock. You want to be selective in which stocks you buy, and this is because movements in interest rates are notoriously difficult to predict. You want to buy the right stocks and let declining interest rates be an extra bonus on top. This naturally raises the question of what characteristics should we as investors are looking for in stocks. But thankfully for us, Ackman has provided a checklist of criteria that he uses at his multi-billion-dollar hedge fund, Pershing Square. Here are Ackman's 4 criteria for what make a stock something that could be worth buying. The first criterion is that a business needs to be simple. Look at the stocks in Ackman's portfolio. He has home improvement retailer Lowe's, fast casual restaurant Chipotle, Brands International, a holding company that owns brands like Burger King, Tim Hortons, Popeyes, and Firehouse Subs. We also have the hotel chain Hilton and the railroad Canadian Pacific. While these businesses are in different industries, they all share the common trait of being relatively simple businesses. The next criterion is that a company needs to be predictable. This means that you should be able to have a rough estimate of how much money the company will make in any given year. Think of predictability as a spectrum. On one end, you have highly predictable businesses like those that own real estate, for example. Every year, that company's profit will grow a little bit as rents are raised. You could project out what the company would be making 5 years from now, and odds are you won't be too far off. On the other hand, you have companies like electric vehicle startups. In 5 years, these companies could be making billions in sales, or they could be bankrupt and do $0 in sales. So if you look at Ackman's portfolio, his stocks definitely fall towards a very predictable end of the spectrum. The third criterion is arguably the most important. The business must have what is referred to as a moat. Capitalism is brutally competitive. If a business is making a lot of money, someone else wants to come along and take the profit from that business. A moat is what stops competitors from destroying a company's profitability. Picture a castle. In our analogy here, this is a company's ability to generate a large profit. The larger the profit, the more rival companies are going to come after that castle. The moat around the castle in this picture is what keeps those competitors away and allows the company to remain highly profitable. Now into criteria number 4, if the stock market has met the first 3 criteria, simple, predictable, and has a moat, and now has to meet one more sale at a discount. As we talked about earlier, a stock is valued based on the cash flow it will generate, which is referred to as the stock's intrinsic value, thinking of intrinsic value as what stock is actually worth, which can occasionally be significantly different from what the stock is currently trading at. Here's how to think about it. Let's say that you determine that a stock's intrinsic value is $100. You don't necessarily want to buy the stock when it is trading at $100. Instead, you'd want to buy the stock when it is trading at least, say, $70. The $30 difference between what the stock is currently trading at and its intrinsic value is what is referred to as your margin of safety. This margin of safety keeps you from losing money if your estimate of intrinsic value turns out to be incorrect. A margin of safety is especially important when you have a concentrated portfolio like Ackman. He only owns a handful of stocks in his portfolio. This means that even if he's wrong only about one of his stocks, the results can be disastrous. These 4 criteria have helped Ackman become one of the most respected investors in the world. Yet they are simple enough that you can start applying them to your own investment strategy. Remember, you should be looking to invest in businesses that are 1. Simple, 2. Predictable, 3. Have a moat, and 4. Are currently trading for less in their intrinsic value. Did you learn something from Bill Ackman today? Share your thoughts in the comments section down below. We will gladly appreciate it.